My name is Alex Roggins. I'm the CTO at YDC. I'm thrilled to join you at this year's MIT CDOIQ Symposium. Sunil, Soares, and I would like to welcome you to our sessions on data economics. I hope to see you there. Thank you.
Hi, everyone, and welcome back. This is Track 2, Session 12-2, Data Economics. And I'm here with Sunil Soares and Sanjeev Varma, and have the pleasure of introducing them as the track producer. Let me tell you a little bit about Sunil, and actually Sunil and I met a long time ago, and we worked both for IBM a very long time ago, and I've kept up with many of his thought leadership work, very impressive on data monetization. And you know, data monetization is something we all struggle with, providing the value to our stakeholders and our executives who pay the bill. And Sunil and his company are an expert at it for now, and really a good session to listen to. So again, Sunil is CEO of Your Data Connect. It's a software as a service firm, and it's based on data monetization. His past roles include the CEO of Information Asset, the Director of Data Governance at IBM, and a management consultant at Booz Allen and Hamilton. And again, he has over 15 years of career experience in data management as a practitioner, the thought leader, as also as a consultant. And he is passionate about the intersection of data management and finance. Right? And Sanjeev Varma. Sanjeev is the CEO of Information Asset. He took over that role from Sunil, right. And he's running that consulting business, and he's going to also participate in our panel today. We will run this session for 50 minutes, and after 50 minutes, there's 10 minutes of Q&A, which we will take questions from the audience here as well as online. I'll be monitoring that. So with that, Sunil, Sanjeev, turn it over.
So before we get started, I just had a request. If any of you haven't participated in the poll that we had actually put out there, please do. Just wanted to actually get a context about how data valuation is relevant in your enterprises or in your roles. So just wanted with that. So far, we've gotten 20 responses back on the question, and majority says yes. There is data valuation being done within the enterprises. So that's actually a good context.
How many people respond?
15, well, it's going up right now, 18 out of 24.
18 out of 24 say they are valuing data in their organization.
That's right.
I thought that number would actually be lower, but that's great. So good afternoon. My name is Sunil Soares. Strike out data monetization. I've been doing A/B testing on data monetization and data economics. And data monetization, for the most part, tends to be a very short conversation because people think, oh, if I talk to senior management about data monetization, it means selling the data. So data economics is more palatable. In fact, it's the same thing. Yesterday at current session, we talked about internal data monetization and external data monetization. And if you think about it, Google or Meta, Facebook or Twitter, for that matter, they make most of their money by using our data internally. They don't actually sell our data, right? They're using our data internally. So for the most part, if you think about it, most companies will get pennies on the dollar. If they're actually selling their customer data, they probably get much more in terms of using the data internally, though that doesn't preclude one or the other. So we prefer the word data economics. It doesn't mean you've got to follow that approach, but we do. So what we'll talk a lot about today is how does data economics intersect with valuing your data? What can you do in terms of making decisions around the data? What does that mean for the chief data officer in terms of how they can pivot their role to speak the language of the board? Those are some, and also how does data economics tie into this concept of data products? Everyone's talking about data products in the context of data mesh. If you talk to 10 people, you get 11 answers of what data product is. I got a table from Snowflake, that's a data product, et cetera. So we'll tie in this concept of data economics to data products as well, okay? So first off, this is where I like to start. Enlightened CFOs and activist investors have the opportunity, and of course, by definition, boards of directors, CEOs, CFOs, ultimately chief data officers, have the opportunity to grow market capitalization based on the hidden value of data. So we took the market cap for the S&P 500, we excluded FANG, right? Facebook, well, it's Meta, Alphabet, because most of them get 90% of their value from the data, probably 100%, right? If you look at Twitter, for example, they get 100% of their revenues from advertising. So you could say 100%, right? Facebook, Meta is about 83%, Google's 93%. But we excluded those. We excluded Tesla. Tesla gets a lot of their value from the so-called self-driving data that they gather, the full self-driving data. So we excluded Tesla as well. So I know the market cap has been going up and down. Let's say it's around $32 trillion, excluding FANG and Tesla. We think a very conservative estimate is 2% of that $32 trillion is hidden because there's alpha associated with the data. So that's what I want to leave you with, and I'll walk you through examples. Some of them, of course, are anonymized, but that's the thesis. The thesis is there's 2% of the market cap of the S&P 500, and frankly, any company, that's around the data, and it's alpha. Now, if you think about it, you go to the CFO, and I talk to CFOs, and they say, I don't understand data, because why? Data is not necessarily put on the balance sheet, because it's not GAAP related, right? GAAP is generally acceptable accounting principles, or IFRS, International Financial Reporting Standards outside the US, they don't require you to record data on the balance sheet unless you pay for it. And even then, you probably would expense it. The second point is you can put goodwill on the balance sheet, but you don't necessarily put data on the balance sheet. So you buy a company, and then you look at the tangible assets, right? Plant, equipment, automobiles. You look at what you paid for it. The difference is goodwill that goes on the balance sheet. So the CFO says, I'm not interested in all this data stuff and putting it on the balance sheet because the accountants are not telling me to do it. Great. But the counter to that is, at some point it's going to happen. I don't think we necessarily have to wait for the accounting bodies to catch up. But if you read, for example, the financial statements for any of the oil majors, ExxonMobil, they will actually put an estimate of what the reserves are under the ground. So ExxonMobil will say in their notes to the financial statements, the value of untapped gas reserves is $100 billion. I don't know. Think about that. I get this a lot from a lot of CDOs. It's too hard to calculate, Sunil. And the CFO doesn't ask me to do it, so I'm not going to do it. It's not an excuse, because at the end of the day, how do you calculate the value of gas reserves under the ground? You have to think about what's the gas price going to be in 30 years. We barely know what the gas price is going to be next quarter, let alone 30 years. You don't know what the recovery rates are going to be, right? So saying that it's hard to value data is not an excuse. Secondly, from a very selfish perspective, which I'll talk about in a minute, as chief data officers, right, are the chief curators of data. It's not the CFO, it's not the CIO, it's not the chief marketing officer, it's not the CIO, it's the chief data officer. So we believe, right, from a thesis perspective, the role of the CDO needs to evolve to be much more focused on curating data as an intangible asset and everything that goes along with it. How do you value data? How do you make decisions around when you do a data valuation? How does the skill set within the CDO community and everyone in the CDO organization change? Because I look at a lot of backgrounds to CDOs, a lot of data, a lot of technology, great. But there's a lot of CDOs who've got accounting in their background, so maybe CDOs need to start thinking about bringing those kinds of skills into the organization so you can speak the language of the CFO. So that's important. So clearly that's one topic. The second one, on the right side is very important. So 2 years ago, at the height of COVID, all the airlines were running out of money. So when I'm talking to you about, data valuation and all is great, but you go back, CFO is probably going to say, yeah, go away. I'm maybe not focused. But when your back's against the wall, you're running out of liquidity like the airlines were 2 years ago, then you'll do whatever it takes to stay afloat, right? So in the case of all these airlines, United, Delta, American Airlines, they actually pledged their loyalty programs to either the US Treasury or to banks, and they raised money. So in the case of United Airlines, Mileage Plus, those of you who have frequent flyer miles, Mileage Plus or Delta Sky Miles or American Advantage, Mileage Plus is a wholly owned subsidiary of United Airlines. It's structured as what is called a bankruptcy remote entity. So if United Airlines goes belly up, that still survives. So the business model is your Mileage Plus will sell miles for 2 cents a mile to the likes of Hertz, Hilton, Marriott, and they get 1 cent a mile from United Airlines. So they pay 1 cent a mile, so 50% gross margin. So they filed what is called an SEC 8K report. I didn't make it up, SEC 8K report. They looked at cash flow and said the value of our Mileage Plus program, the whole company basically, is worth $21 billion, right? Their net income was around $4 billion. They applied a price earnings ratio. They got $21 billion. When we went and talked to the airlines and the folks who did the deals at these airlines, they said the value of the data, clearly, if you look at a customer, that's what it is, right? United's got about 100 million customers. The value of a customer is much more than just the data, right? It's the brand, it's the loyalty that they have. But they told me the value of the customer data is typically 20 to 40% of the value of the loyalty program, 20 to 40%. That's a lot of, you can also look differently and say, how do I come up with that number? Well, typically, if there's a data breach, a big data breach, like a Capital One, for example, God forbid, the market prices of companies that have had a severe data breach will underperform the stock market, NASDAQ, by about 8.6% over a year. So even if the number is 9, 10%, that's still a big number. So but if I take 20% to 40% of $21 billion, that's $4.3 to $8.6 billion. That's the value, implied value of the customer data. And lo and behold, the value of United itself at the height of COVID was less than $4 billion. That got us thinking. That's very interesting. And by the way, the value of the data didn't necessarily, crater during the height of COVID, right? So the value of United's data was actually higher than the value of United at the height of COVID. Clearly, it's about 11 to 12% today if you look at the numbers, but it was over 100%. So that got us thinking, if all these CDOs were able to think through what's the value of our data, and you're able to explain it in terms that the board understands. Now you can do very interesting things. This doesn't mean you have to sell the data, but you can definitely justify spend in terms of data protection, analytics, and things like that. So that's the thesis, okay? And Sanjeev's going to cue me on when we have the next poll question. So what we're trying to do here is to say, how do chief data officers communicate the value of their data internally and externally? So the estimated IT spend is around $3.9 trillion in 2021, according to Gartner. The average budget of a CDO in any large organization is in excess of $30 million. I'm sure folks in the room, it might be higher, it might be lower. It's not a small number, right? Even if the CDO doesn't have that budget, that's typically the data budget in any large organization. Unfortunately, the average tenure of a CDO is 2.4 years, right? And that's just the nature of the beast. I talk to a lot of CDOs, and we always get questions on why is the tenure so short? Because the CFO tenure is not 2.4 years. The CIO tenure is probably longer, but why is the chief data officer tenure only 2.4 years? Clearly, the role is evolving. And maybe it reports into IT, when otherwise it should report into the business. But the hypothesis we have, and I've talked in the last 3 months to 50 chief data officers with this framework across different industries, and they all agree, right? The implementation is different, but they all agree. Fundamentally, the issue is they are not able to successfully communicate the value of what they are doing to the organization. If you're in a bank and it's highly regulated, great, right? So you can probably justify compliance for LFI if you're a large organization, or Solvency II or CCPA. But potentially on analytics you might be able to, but invariably that seems to be the challenge. So as a test case, we talked to a CDO at a large manufacturer recently, and he said he was very proud. He said, I spoke to the CEO. I said, great opportunity. Spoke to the CEO. I said, dude, what did you tell the CEO? So, well, I told the CEO I have 2,000 FTEs in data. I'm like, okay. And I have $300 million in spend. Now, I'm an accountant, by the way. So I'm an accountant. I've trained myself around data. I've trained myself around technology, but I'm an accountant. I said if the CFO looks at that, he's going to say, okay, my price earnings ratio is 9.5. So what I'm implicitly thinking is if I fire everybody in data, literally. It won't happen, clearly, you can't run your business. But let's say I fire everybody in data, then theoretically what I'm doing is I'm flowing $2.8 billion to my market cap. That's how CFOs think. And you don't think they're thinking these days with, who knows where the economy is going? So the real question is, are you generating value? Or using, current terminology, are you generating data products equivalent to that number? And if the answer is yes, great, are you communicating it effectively? If the answer is no, then you need to do something about it, right? So that's the question. And then we talked to, someone who headed data governance at a bank, and he said, yeah, $30 million is great, but when you start thinking about our IT spend and our cyber spend and data spend, that's like $500 million. So that could be a bigger problem, but we're going to focus on data. That's fundamentally what we'll do. So there's a lot of academic work that has gone into this concept of intangibles. So if you look at the S&P 500, and Karan had this in his talk yesterday, in the S&P 500 on average, the intangibles, and an intangible is anything you can't touch. So like a building, you can touch equipment, you can touch machinery, but you can't touch your brand, you can't touch data, you can't touch goodwill. So typically intangibles make up 90% of the value of the S&P 500. A couple of years ago it was 80%, now it's 90%. 90%, right? And that's not reflected on the balance sheet. Now, everyone understands about certain intangibles. Goodwill, clearly, right? Customer lists, yes. Intellectual property, everyone understands that. But people don't necessarily think about the value of data. Now, of course, you have to consider, how do I separate data from those other intangibles assets? So if I've got a customer, that's an intangible asset, but how do I separate data from that intangible asset? Totally understand that, right? Now, so the data needs to be included. So, for example, when you start thinking about private equity and hedge funds, there's examples of hedge funds who will, from a tangible perspective, they'll buy newspapers. And you wonder, why is a hedge fund buying a newspaper? Well, let's say they spend $50 million for the newspaper. There's this beautiful real estate downtown. So they sell the newspaper, they sell the real estate, hollow out the newspaper company, unfortunately, and now they have the newspaper company for free. So if you start thinking about that concept here, right, with data being a significant intangible asset, Google, for example, bought Motorola 17,000 patents for $12.5 billion in 2011. So we got to start thinking about how do we grow the value of the company focused on these intangible data products.
Can I actually ask you
Yes.
for a second?
Yes.
So I think actually that certainly set the stage for the thesis of what we're calling as data economics right now, right? So we're probably going to start shifting gears a little bit into how do we actually start looking at this from a tangible project perspective? If you're launching an initiative in an enterprise, how does this really translate into that? So we have a question for you. If you haven't responded back, the question is, have you justified a data strategy based on ROI? So if you haven't responded, please do, because we are slowly looking to shift gears, and I think you're probably going to switch to the website as well, right? No.
Got an answer?
I'll give up a few seconds. So far, we have, 23 responses. 50% says yes.
Okay.
We have used an ROI-based justification for a data strategy. So that's a very positive response.
So what we've tried to do is we've got a measure called a data monetization index and an intangible asset index. So what are they? They're very simple. It's basically what's the value of your data divided by the value of the company. Higher the better. So Google, for example, is 93%. Or an intangible asset index to say, what's the value of all my intangible assets, right? Excluding maybe brand and your marketing agency might do a good job with that. All the data-intensive intangible assets that the CDO organization would have something to do with. So what we've done is we basically created a database, right? So we've got a database of stock prices, Wikipedia, SEC, annual reports. There's so much data out there, so many signals. We pull all that in to say, okay, what's the value of a company's data relative to the value of the company itself, right? And then you're only as good as what the public information is. So I'm going to show that to you, and then I'm going to switch gears. So excuse me, can we switch to? Yes. All right, so you can see this. So this is our website, yourdataconnect.com, focused on data economics. So what we have here is a benchmark. We've got this concept of a data monetization index, and these are the S&P GICS codes, the sector codes. So you can see communication services is high. That's where you've got Facebook and Twitter and Netflix is in there. Consumer discretionary, this is where you would have the autos. Consumer staples is retail. So you can see we've got financials are pretty high, right? It probably should be higher than 50%. And then you see some of the others. So these are, we've got a benchmark. But now the next thing we've done is, I'm just going to pick one company. I'm going to pick the Coca-Cola company. So you see right here for industry soft drinks, the value of their data is $83 billion. And as I said, it's only based on publicly available data, right? Even if we had private data, we wouldn't use it. And it's only based on what I would call certain data products, right? There could be a lot of data products. And this is what I would call current data valuation. If Coca-Cola is thinking about some great plans to use AI in the future, we wouldn't be aware of that. We wouldn't put it on the website. So it's current data valuation. It's not potential data valuation, okay? So data valuation is what, $83 billion? This is the value of the company, enterprise value, as of maybe a week ago or so. So the data monetization index is what, 26%. Now what we've got is we've got a benchmark. So you can see, you know, Altria Group is at, what is it, 10.95%. Coca-Cola is at 26%, et cetera. And then the other thing we've got is we've got an analysis to say what is Coca-Cola's data monetization index is 26%. The average for the industry is 11.6, right? Good enough. And then we've just got a breakdown here. So what's the value of their loyalty data? They've got a loyalty program. So if you're thinking of consumer packaged goods, you've got customers, but how do you know who your customers are? How do you get that first-party data? So the way they do it is they have loyalty apps, right? That's the rage in the restaurant business. McDonald's has it, Yum has it. Because how else do you get that first-party data unless you have a loyalty app? I know in the past, for example, Anheuser-Busch would say, register your email address and the app will give you a free beer. So you think the value of the data is worth the beer, right? The cost, it's actually way more than a beer, which is why they've given you, the cost is a beer. So loyalty, so it's basically what's the value of the customer. I'll walk you through customer lifetime value in a second. What's the value of supply chain? It's not counting other data products that Coca-Cola has. For example, they've got ESG. They've got a whole program on ESG. There's a tracker on ESG here. That's not covered. And then the other thing that's interesting is, it's great that with the value, what are we doing from a spend perspective? So obviously, there's ways that you can figure out what the spend is. So we've just said, what are the total number of data management employees? You can find that out from LinkedIn. You can look at titles. And then you can look, we've got the total number of employees, which you get. So we've just got a simple ratio. And you can see Coca-Cola is about 1.65%. And you know, some of the others are, Clorox is 1.8%. So it doesn't tell you what the mix is in terms of onshore versus offshore. If you have FTEs, they won't be reflected in these numbers. It's just another way to think about this. Can we switch back? Okay. Looking at the time. Got another 20 minutes to finish the presentation. So now you start thinking about these, you know, these signals, right? So we've got cross-industry signals. We've got, you know, signals based on the company, the division. What are your data products, the data management spend? I won't spend too much time on that. So what you got to think through is now, you know, what I would call when you're valuing data and valuing intangibles, you've got what is called a MISI. When I was a consultant many years ago, mutually exclusive, completely exhaustive. And the reason I say that is, as CDO organizations, I've talked to folks at the EDM Council. A lot of CDOs want to value every project and every program. So I would say that's great, but you run the risk of saying, I want to value every project, I value every program, I value every report. When you start going bottoms up, you'll end up with an infinite valuation, because a lot of these data products, they're valuable, but they have overlapping value. Does that make sense? So you have to be careful. So you should do both, and I'm going to walk you through how to sort of do both, but start with the tops-down approach. So really think about everything intangible, and I would qualify it's really intangible that's data intensive. So we're not necessarily saying we're valuing the brand or valuing intellectual property. So we kind of created these buckets. We've said, okay, I've got customers, I've got equipment. Now, to be fair, equipment is tangible, but I'll walk you through an example of why it would matter. Intermediaries, real-world data and life sciences, data management, and other intangible assets. So for customers, customer lifetime value, right? So customer lifetime value, a portion of that will be attributable to the data. And then I'm just using different vernacular for customer based on a different industry. So you might have residents in real estate, passengers in airlines, diners and restaurants, et cetera. Equipment, why does that matter? I'm doing another session this afternoon. We have gas power company, they sell turbines. So you have what's the customer lifetime value of a gas-powered utility that's buying turbines. But you can also think about what's the lifetime value of the turbine. So the turbine itself is tangible, but the two together make a lot of sense. So if you're selling farm equipment, you can think of the lifetime value associated with the farmer who's buying your equipment, and you think of the lifetime value associated with the equipment that's generating all that telematics data. If you're an aerospace company, you can think of what's the lifetime value for the airline, and you can think what's the lifetime value for each aircraft engine, which is generating data. Intermediaries is very valuable. So you could think of many companies don't necessarily work directly with customers. They also work with intermediaries. They work with dealers, or they work with advisors in capital markets. So you think of the value of both of them, and then various others. So electronic medical records is a great one. We have a hospital company that we're working with, and they gather electronic medical records, right? Most of you who work with doctors and hospitals, there's an electronic medical record. What's the value of that data? Clearly, it's very important to us, but what's the value? If you go on the dark web, you can actually buy electronic medical records for about $350 per record. Going great on the dark web, $10 for a social security number, some number like that. So there's ways that you can think about the value. So when you think about it that way, you can assign a value and then decide how much am I going to spend on it. Data management, you can start thinking through what is the value of regulatory compliance. Those of you in banking, there's a value associated with regulatory compliance, and you can distill it down to what's the value of my tier 1 critical data element, right? Et cetera. So now I'm going to walk you through a use case. I've got 2 use cases. I want to make sure I have enough time. Yes, go ahead.
Quick poll, actually, if you haven't responded back, there's a question about have you used data products approach in your enterprise, right? Because this particular use case is going to dive a little bit detail into the data products, and the next one has got a slightly different context. Okay.
All right. We'll give them a minute. I'll dive in.
Yeah.
So we're going to walk through real estate. So when we did this work with this real estate company, you would think most real estate folks, they're thinking what the biggest value is the real estate itself, right? Data has some value, but you'll see how we looked at it here. So first off, you start with what is called a data product inventory. So, I've done data governance for a long time. If you've implemented Colibra or you implement Cachefia, Informatica, you've got communities, domains, there's a lot of similarity. Not exactly the same, a lot of similarity. So think of these as, data domains that they identified. So data domain 1 is all, you see right there, real estate data. So those are the ones with the red box are the ones we actually focused on. So domain level 1 was real estate data. And then we had occupant master data. So this company is a large property manager. So they've got hundreds of properties all over the world, and they're managing properties. They don't own the properties for the most part, but they manage the properties. So for them, there's 3 major domains. There's the resident. They want to maximize the value of the resident. Then the residents live in what are called communities, which are buildings, fancy word, buildings, properties. And then the properties are owned by owners. So there's three major domains, right? So the key here is when I said mutually exclusive, completely exhaustive, right there, the first domain is resident customer lifetime value. And then the number first, second, third, fourth, fifth one is owner. And then I've also got, I don't have property, but the three together, you cannot add them. You can't add the aggregate value for the residents and add the aggregate value for your community and owner. They actually duplicate. So if you think about hierarchies, much like you're thinking about product and PIM, you can think of your data products in terms of a hierarchy. And you can think of having multiple hierarchies. So in this particular hierarchy, I can think of resident as one. Another one is float. So float is, I'll explain. I get money at the start of the month, but I don't actually pay the money out for expenses for my residents till halfway through the month, so I've got a float. That probably should not be added to my customer lifetime value. It's included. But now they've got another one around price elasticity and credit risk. So price elasticity says these days, what happens if we raise our rents by 10%? What kind of attrition do we see, and what's the optimal pricing point? So that's more of a potential data product. So it's totally okay to add that value to whatever I have in terms of customer lifetime value. It's potential. And the same thing with credit risk, right? I have a platform. I've got some interesting information that could potentially be an additive one. So it's important to understand what's additive and what's already included in your base value, and there's a whole bunch of others. So we start with the concept of a data product. The next thing I did, and this is to protect the innocent, I've changed some of the numbers, and it's all public information anyway. So this one is a company that has $22 billion in enterprise value. So enterprise value is a very specific term in private equity. It's your equity plus long-term debt minus cash. Most of these real estate companies are highly levered, right? So you have to typically add the value of long-term debt to get enterprise value. So you see right there, I've got a base case, right? And I've got the value of my intangible product, which is customer lifetime value, is about $1 billion. So the data monetization index is 5.39. And then I've got a very small number. It's not a big number. It could be much bigger. For I want to sell my renter data, anonymized, I might get, that might be worth $2 million. But right here, we've got numbers, and I apologize. I'm an accountant. I like numbers, but I recognize not everyone's like that. But your finance people will. So I've got very detailed numbers, but we won't go through them. But this particular business case says, what's the value? What's the aggregate value for my customers? And then it's got some analysis on what happens if I provide some rental concessions to my renters, and I increase my customer lifetime value. And this is a very interesting one. This is a potential value. So if you're familiar with prop tech, real estate data analytics, there's a big focus on if I've got two buildings, they're pretty in the same neighborhood, but how do I predict if the rent per square foot is going to be higher in one property versus another? So you start looking at things like, what's the walking distance to a bus stop? Has a high-end restaurant open nearby? And most importantly, what's the credit score for a tenant in that building? Because the higher the tenant score, you would expect that they have a higher propensity to pay higher rents. So who has that credit score? It's the landlord, right? So there could be a potential data product around packaging up on an anonymized basis, and saying, here's this property, and here's the anonymized data relating to that property for credit score. So that's a potential data product. So this is what we came up with. We said, here's the customer lifetime value summary. Existing customers is 22,939. And this is not just data. I want to be clear. This is taking the entire intangible product, which is customer. And then there's a cost to acquire. So I'll walk through some of the analysis here of what we mean by cost to acquire, not publicly available. So the CLV is basically the same. What can you use the CLV for? You can drive a next best action. Many of you are doing it. You can drive a next best action based on the value. So you can now bring this down to the individual customer level. So a lot of companies now will think about, how do I add CLV, score it in my database, whether it's Databricks or Snowflake, and then actually send that to Salesforce to drive a next best action, or send that to Informatica C360, right? So as another attribute that I can master in MDM. So this is very detailed information. I'll walk you through it at a high level so you can understand some of the drivers. And I also am cognizant of time. So this is rental metrics. This is the company, a number of markets they're in. We've gone through all the information on rental income. And then you can see you model out what the cash flows are over 36 months, however long you think the tenant is. But now, a key driver of this would be what's the churn rate. I don't know if I have churn rate here, but right there, monthly churn rate is 4%. So you can start to think about your data products as in terms of a hierarchy. So I might have a data product around resident lifetime value. I might have another data product under it around churn, right? Or many of us have churn models. So now when you start thinking about data products, that's a hierarchy. And then this is the model in terms of customer lifetime value methodology. I will be sensitive, so I'm going to skip over it. Suffice it to say it's quite detailed, right? And now what we've done is, you can see right here, we just did a Monte Carlo simulation here. And now I've got all this data. So you can think of this as master data. But now we've got a CLV at the customer level. You see I've got customer 540. And now we've got their customer lifetime value all the way on the right side, $40,000. And now we can segment them, right? Maybe we use more for demographic-based segmentation, but this segmentation on CLV could be used to define a segment, okay? Now the other thing, we talked about having different types of hierarchies. So not only am I doing a CLV at the resident level, I'm doing it at the property level. So now I can see, okay, for this, if I've got all these properties, how many regions are they in? 5 regions, 21 markets, 160 communities, 53,000 homes, and I can see what my average customer lifetime value is at that level. So it's quantitative, it's data economics. Great that it's at a high level, but now it's a little more detailed. And then this particular company was interested in, all right, how are we doing? First off, the CDO wanted more budget. So can I go to my boss, the CIO, and tell him or her that I need more budget? But tough luck, because in this case, they were $4 billion in enterprise value. One of their competitors was about half. They had about double the number of employees, 26. So double the enterprise value, double the employees. So you put a fully loaded data management expense, see what his data management spend is. And then, his data management spend versus enterprise value was 16 basis points, 1.16%. His competitor was 0.14. So you can't really say he's totally underinvested. Okay? And then I'm not spending much time, but this is how you could potentially operationalize this. So this uses a combination of Azure Data Factory. I'm sensitive to time. Azure Data Factory, potentially bringing everything into Data Factory and computing what's the CLV. So this is not just some theoretical thing you run in Excel, right? And then you can actually, you can use Synapse, brought this into Synapse Analytics. So we used a combination of Synapse Analytics, Azure Data Factory, to be able to run this, okay? So that's one use case, all the way end to end, starting with data products, financially oriented, and then getting down to other technology. So from my perspective, right, most chief data officers, and if you look at the CDMP exam, it's all focused on data and technology, right? But I think now there's another muscle that the data management community needs to develop, which is around finance. Basic terms, basic vernacular that you can talk about with the CFO, okay? The next thing is many data management folks are scared to have that conversation. So I'm really looking for the CDMP community to start saying, we need to have a module on financial literacy, not just data literacy, but financial literacy for data professionals. So manufacturing use case, the next one. So this one, I'm going to combine basically an intangible asset, which is the customer, and a tangible asset, which is a turbine. So in this particular case, the company bought MDM. They bought MDM, but they were struggling to justify the value of the MDM program. And in reality, it's all about getting more revenues. It's as simple as that, right? It's all about getting more revenues. So they were selling gas-powered turbines to utilities around the world. So there aren't that many utilities in the world. I think it's 7,000 utilities. You can enumerate the number of sites. And this public data that says which utility has how many gas-powered turbines, how many wind turbines, how many offshore wind turbines, onshore, nuclear, all that information is available. So what we did here at the very high level is to say, I've got one intangible asset, which is customer. I've got a tangible asset, which is turbine. and then I've got some analytics. So at the very top, the average customer lifetime value was $16 million, right, for a customer. Big utility, small utility, it's business to business. The turbine lifetime value, so the average lifetime value for a turbine was about $10.5 million. But they had long-term services agreements with companies, and they literally were servicing 1.57 turbines per company. So you see 1.57 times 10.5 is about 16 million. Now comes the interesting part. Each turbine, the lifetime value was $10.5 million, but the Gillette model, when we actually looked at their financials, it was very interesting. Gillette model, they lose money, right? They lose money when they sell you the initial, I don't know if it's the blade or the razor, I can't figure it out. Whatever the first thing they sell you, but they make money on the razors after that. If you think of the aircraft business, the engine business, Rolls-Royce will lose money on the initial engine, but they make tremendous amount of money from the servicing. So in this case, the turbine lifetime value, they were losing money every time they sold a turbine, $500,000. But then they had long-term services agreements with those customers worth $11 million. So the turbine lifetime value was 10.5. So now they had, you read their report, you'll see they had 1,800 turbines with long-term services agreements. They have 7,000 company gas power turbines. So they had a fleet out there in the market, 7,000 gas turbines, of which they had long-term services agreements only with 1,800. So right there, that's the MDM. Who cares about everything else? It's that, right? So there's about 1,100, they had 1,100 customers, 1,800 turbines with long-term services contracts, so 1.57 turbines. So that's the math work. So now you can think of all types of very interesting possibilities around MDM. How do you drive your CRM with Salesforce and things like that, which is what I'll show you now. So this is all the math. In the interest of time and not to put you to sleep, I know Maria's going to give me the hook pretty soon. So you can see we've got the equipment numbers, and we've got everything around revenues, gross margin, what's the cost to serve, what's the cash flow. And now you start thinking through, it's very interesting when you think about the churn model. Typically, when they sell a gas turbine, the contract is for 7 years, right? But who knows what's going to happen with gas prices, the transition to renewables. So it's very hard to think about what the churn model, the churn rate will be in 7 years for gas turbines, because customers are maybe retiring gas turbines, right? So we assumed no churn for 7 years and then 25% churn after that. These turbines can last for 36 years. So there's potential to do some more churn modeling around that. There's the methodology around CLV. Now you can start thinking through, how do I make this relevant from an MDM perspective? So in this case, we took some real data, actually. These are all real utilities and real, everything real, right? So CPS Energy, they have an Arthur von Rosenberg gas plant, 550 megawatts in Texas. They're a municipal utility in Texas. And this company actually has a long-term services agreement with CPS Energy, and they've got 2 turbines. So 2 turbines times the customer lifetime value is 20 million at a high level. Probably make it easier. And then we said, okay, you can pull a list of every single utility, and you actually would know if the utility has their gas turbine or somebody else's. So you can start scoring a CLV. So you can start thinking through now, from an MDM perspective, CLV can be an attribute. I can score it in Snowflake or in Databricks, whatever it is, and then I send that to MDM, right? So I can see it. And then potentially the beauty is I can then drive a next best action. So this is Salesforce. So in Salesforce, I've got a next best action to say CPS Energy, the industry's utilities, does it have a long-term services agreement with us? Checkbox, yes. Next best action might be, I need to make a call to make sure the turbine is still operational, something simple like that. That could be a next best action, and I've got an upcoming task in Salesforce. Or I could have another, was that it? Or I could have another task for a utility or a turbine that doesn't have a long-term services agreement. So I think I have 15 minutes or?
Yeah,
7?
probably.
You have 17 minutes.
You got 7 more minutes, right? Q&A.
So we're good.
No, I think actually we gotten some response, but I just want to put that into context to the last two scenarios that Sunil talked about. So the first example was around a data product-centric approach and how that ties into data economics. And second one was around how do we do the ROI for a particular initiative, right? So when we did the polls, one of the things that the audience actually responded back was that close to 70% of the initiatives have an ad hoc project-based ROI model, right? So when we actually talk about the example that Sunil talked about for MDM initiative, when we tie in that C&V value, that probably is something that we should really be looking at as a business KPI ahead of it, so that does it make sense to get into an MDM project? Is this the right thing to do? Is there a potential that can be unlocked? This could be a great tool for us to figure out, is there value that can be unlocked? And then the other one was around the data products, and that was an interesting one. 80% of the audience are using a data product-centric approach in their enterprise. Now, from an economics perspective, there are different ways you can start configuring that, right? So there is a lot more relevance in this economics, and take a data economics point of view, either in the data products approach or when we are actually putting together an ROI-based model for a project. So just wanted to tie that into the polls and how it was actually relevant to this conversation. That's it, Maria, back to you.
Okay. So look, I think at this point, we're going to go take questions from the audience here. And so you'll first start here and then.
And virtual?
Yeah, and then virtual.
Yes, correct. Oh,
And by the way, if you can get to the mics, I know sometimes we
Yeah,
don't
right
make
here.
it easy, but yeah.
and I'll repeat the question as well.
Great.
If that helps. It'll be a tough one. Okay.
You have a Salesforce slide up, you have SAP, Maria here. So why have you not included the YDC product in SAP yet?
I already, so
Cornered me already outside for that.
I asked her about it already. So yeah, exactly. Right, if you want to target the CFO, you better be targeting SAP Finance. Yeah, it's a to-do.
Okay, so that's a tool for you then.
It's a to-do. Yes.
Thank you. So you started saying basically the CFO could just say, okay, I'm going to fire the whole data organization and Wall Street will be very happy and my stock will go up and my bonus will be
It
fat.
was an
and-
extreme.
it was the reality.
Okay.
It's, I mean, it's extreme, but unfortunately, it's reality. And most CFOs today and CEOs, they understand the value of the data, and they understand it's there. But the challenge is, if you went to Wall Street and told them, "Look, we have all of this value here," they would not react the same way as if you said, "I just cut $2.5 million or $1 billion of." So yes. Communicating the value is, I think you're absolutely right, it's critical. But the question is, how do you communicate the exploitability of the data so that Wall Street will feel good about that you have all of these capital?
Yeah. So I think the question was, everyone on Wall Street understands the value of the data, but how do we paper it? I guess that's really the question. How do we paper it? How do we actually make sure it gets reflected in the stock price? Right. So the 2 points that I want to make are, and I hope I'm not too provocative. Everyone understands the value of the data, but not everyone understands the value of the CDO. Right? I'm just speaking. I mean, the average tenure of a CDO is 2.4 years. So I was talking to a friend of mine who's a CDO, and I said, actually, I'm a consultant originally, so the joke started as consultant. Consultants are like baseball managers. You always get fired. The only question is when. So then I changed that to say CDOs. CDOs are like baseball managers. You always get fired. The only question is when. So I sort of ended this discussion with that. But the point is absolutely right. And the way you do that is you're going to have to be able to demonstrate at a high level. No one cares, right? Data is worth 20%. Who cares? But you have to bring it down to what does that mean in terms of tangible projects that I can run. Can I actually increase my customer penetration rate by 2% and drive EBITDA or cash flow by X? That's when they start understanding it. Right?
If I may add, actually, Sunil, I think not for the public companies, but some of the conversations that we had was with private equity investors. So the same thesis that you're actually talking to them, they are actually able to relate to that in figuring out what actions could be taken in terms of either a revenue play or an acquisition play or a merger play at that point of time. So we certainly see this conversation resonating with that investor community, maybe not as much in the public forums, but in the PE forums.
I will also give you an example. I won't use names, but we were working with a company in the home leisure space, and they have 5-6 million members, right? And they've got a loyalty app, great. There's only so much they can do in terms of growing the value of the company post-COVID, et cetera. But if you think about it, they were a potential target for a much larger company to help that larger company get into the metaverse. So if you, because of what they were doing. So if you actually looked at the potential value, not the actual value, the potential value, the value of the metaverse data was approximately $100 per user. And why do I say that? Because I use Oculus glasses now. I didn't before, but I had my 16-year-old teach me how to use Oculus glasses. And then I actually went and read, if I'd encourage folks, go read the privacy policy for Oculus, right? It's frightening in one way, but it's also very exciting in another way, because it's frightening because they can do anything with your data. First of all, they can track your eye movements, and they can. So before you like something, they look at your eye movements, and they can track what you like. They can track your hand size, dimensions of your room, whatever is in your room. So there's a value associated with that. So that's the privacy angle, but there's the value. So I'm taking a very Wall Street mercenary view and saying value, and we looked at what Meta's valuation was at $100. That $100 per user is not reflected in the current stock price. But if you're private equity, you're thinking, I'll force management. CDO is probably not going to be able to do anything, but the private equity folks will say, I'll force management to do something different to unlock the value. Yes,
Sunil, my question is, again, you talked about the financial literacy to be part of the data management or the people in data world. Is that easier, or is it easier to teach the finance people data or add on some of the finance people as part of the CDO office? Which one is easier? Which one have you seen more successful?
So I've seen definitely the chief data officer himself or herself needs to get trained, right? So many CDOs have, many CDOs learned data along the way, right? I mean, they were technologists, so they learned data. So this is just a new skill for the CDOs. And then much like you have, we did this work with this real estate company, and we asked the CDO, so who's going to run data economics? He said, I'm going to run it myself. But much like you have like a data governance lead reporting to the CDO, and you have a data analytics lead, one of our client organizations has a value realization lead. So the CDO actually has a value realization lead whose only job is to work with finance and the business to track initiative by initiative, how much are we capturing, et cetera. So I think the answer is CDO needs to learn and also bring in some skills.
Neil, can I add some of my experience as well? Yes. So first of all, I have a computer science undergrad, but I went back and got my MBA. And so I love Sunil's conversation because it makes me hurt my head, but it also makes me come back to my days of, really understanding accounting and finance and balance sheets and all that. And I do think that CDOs should have a finance literacy and or finance fluency. Also, I would find that many CDOs report into the CFO of organizations. And if you want to have an interesting conversation with your boss, you need to be able to speak in their language. Sure, you want them to understand you, but you're the one that's going to ask for money. You're the one that's going to, kind of wants their support. So I put it on myself to kind of learn the finance side. And I think one of the things that I like about this session also is that a lot of times we say, well, we can't value what we're doing in monetary terms. And Sunil has proven here that there is a way. And there's a very detailed way with a lot of justification and numbers. And when I did this with my CFO, one year I said, well, the value of what we're doing is, it has an ROI of, X percent, 20% ROI, and we're going to return this value. And he said to me, show me. So they're not going to just take your number and your word. They're going to want a show me. And a show me, it was something like this, right? Not only we had all the assumptions, all the numbers, and I think, that argument of you can't value it goes away. And then not only that, you have all this supporting data that makes perfect sense to a CFO, and then you can talk their talk.
And clearly, there's a few different ways you can justify value, right? You grow revenues, reduce costs, manage risk, improve cash flow. Now, I'll tell you, all of us, we've tried to, I've done many Colibra implementations, Informatica implementations. CFO says, how do I justify the value of Colibra? Well, if you're in a bank and it's regulatory compliance, no problem. But otherwise, you say, well, the data analyst is going to spend 5% less time looking for data. And they say, okay, so are you going to take your budget down by 5%? So that's the level of rigor. So it's probably harder. It's easier to justify revenue growth or cash flow, something like that.
Any other questions? You actually don't have any questions on the Q&A. You had over 135 people attending your session,
Excellent.
so live, but actually no questions at this time. I have a question for you. I mean, do you find that when you use this methodology that the same players in the industry have about the same percentage of kind of, data valuation?
So Google is actually 93%.
Yeah.
So real estate's 20%, but those are not the ones I love. We just did one with 3 credit unions. One has 307%. 307%. So either I'm mad and something's wrong with my team, or it's 307%. So their customer lifetime value in aggregate is 307%. The other was 230%, and the third one was 107%. Now the first 2 credit unions, they are I won't tell you, but they have a customer base that's very large, over 10 million. They have a very low, they have target and affinity group. They have a 4% churn rate on an annual basis, great brands, and their customers stick with them for 20 years plus. So, so now the question is, what actions can we take to unlock the value? Now, they're not publicly traded, so they might have a different set of imperatives from publicly traded companies. So those are the interesting ones, whether the data is worth higher, like United.
Yeah, so you can't go on your website and look at your industry, find an
You can.
example, and say, no, I can, and then say, okay, if this company in this industry is this, then my company must be.
Yeah, yes.
No.
We have it by industry.
Yep.
We have it by industry. Like I showed you for Coca-Cola.
Yeah, I do encourage all of you to go look at that site.
She was
It's
critiquing me.
fascinating.
Maria was critiquing me.
No, I'm supporting you now, right? Yeah.
I've used your site for personal investments. If I'm investing between 2 different companies, and I'm spending my own money for buying a stock, but not the 401k, I will actually go to your website, look at which company is more data, which has better DMI index, and then invest in that company.
We had a private equity folk call us, and they were asking me questions. They beat me up, right? What about this? What about that? Free advice. And I said, okay, great, whatever. And then the next week they make an announcement saying, well, we don't think management is doing a good job with this company. They need to sell because the value of the data was higher than the value of the company. So how else are you going to unlock it unless selling it?
If I'm using the website to make money on it, I don't want to do that. It's just a comment that I've used it as a reference for my personal.
Maybe Sunil might want to hear why.
Awesome. Thank you.
All right.
Oh, you have a question?
Yeah, so investment bankers, they like to talk in terms of comparables, and so they break down the value of the company. And data,
Yes.
definitely when they look at data, they would look at the value per customer, for example.
Correct.
This applies to when the data is explicit, like you have a list of customers. But many companies, the data is not as explicit as that. Are you familiar with any examples of comparables?
Yes, so a very good example. So we have time? Do I have?
Oh, yeah, you've got like 3 minutes.
Okay, so if you think about data valuation, you can almost think of like a Zillow model. That's what investment bankers do all the time. It's almost a Zillow model where they'll do two levels of analysis. They'll do a bottoms up. So if you're looking at a property, you say, what's the discounted cash flow for the rental from the property? Or that's bottoms up, like we did with CLV. Or you can do a tops down and say, how many properties in the neighborhood have 2 bedrooms, 1 bathroom, quarter acre, right? Tops down. So when we looked at certain things, like for example, how do I value employee data? How do I value employee data? Well, the answer is you look at comparables. Look for comparables at companies that derive their entire value from that data product. Rule of thumb. So LinkedIn, Microsoft bought LinkedIn for $26 billion 4-5 years ago, and Microsoft paid for 500,000 users, they paid $26 billion or thereabouts. So the approximate value per user, just for the data, because LinkedIn doesn't have anything else, is about $60. So you can say rule of thumb, just for basic data on LinkedIn, it's not all the data the HR will have about the employees. Basic data, $60 per user. We had a company in healthcare said, we're bringing DNA, genomic data into our data lake. How do we think about how much stewardship to put around it, things like that. So there's a 23andMe, most of you are familiar with it. They get all their value from genetic data. That's it. So they did an exclusive transaction with GSK about 3 years ago, where they gave GSK access to their database to do oncology research. GSK got drugs out of it. GSK invested $300 million, right, for a partial stake, and they got access to 5 million records. Rule of thumb, $60 per record. So there's ways that you can apply some science to something like this. Does that make sense? Yeah. Okay. All right.
Fantastic,
Thank you.
right on time. Thank you so much, Sunil. Thank you so much.
Thank you.
So again, we have a 30-minute break, so get something to drink and then come back. And Sunil, you have another session coming up too as well.
Somewhere else, I
Yep.
don't know. Yeah. Thank you, Maria.